So the question out there, so many people are asking is, what do you go and buy given the difficult climate we find ourselves in as investors? Our next guest prefers companies with resilient earnings throughout the cycle. Philip Pepe joins us now live via to go get a chat from Shaw and Partners. Philip, welcome back to the show. It's great to go and see you there. Where do you put your hard-earned dough in this marketplace? It's not the easiest of questions right now.
No, it's not. And there's a lot of uncertainty at the moment, especially as we head into the June reporting season. Whatever the companies report for the year ending 30 June, the outlook statements are likely to be conservative to cautious. So I kind of favour stocks that aren't impacted too much by interest rates or global issues or rising fuel costs, etc. Companies that are more resilient, like healthcare and agriculture. No matter what happens to markets or energy prices, etc. These are essential services. We spoke last week about agriculture. The Australian agriculture sector is booming at the moment. It looks like it's going to be another bumper winter crop and potentially a strong summer crop. So you need inputs to grow the crops, and despite the recent rains, they haven't actually been too bad. So that's a steady earning sector. I think it's one worth looking at, and we like Elders in that space, who supplies a lot of Australia's farmers. But another one is the pharmacy space. You hear every day about more and more people getting sick. We get both the combination of people getting the flu, people getting COVID, etc. Foot traffic is definitely back at pharmacies. People are back to the office, they're getting sick. With a focus on recovery and prevention, we think pharmacy is a good place to put some money in the near term, because the earnings will be very relatively resilient to what else is happening in the economy.
So in that particular healthcare space, Sigma is the company you've identified here for us. What are some of the factors there? I know that they got a lot of uplift from rat tests. Everyone was buying them, of course, trying to go in and see whether they're COVID positive. It just seems to be an ongoing saga for the time being. Besides that, you mentioned the illness that's going around in general at the moment. That is enough to go and boost earnings of that group longer term?
Certainly in the medium term. Sigma is an interesting one because they obviously had the rat test boosts in January, as did a lot of pharmacies. But Sigma's also had some issues implementing an enterprise management system like many companies do. So it's actually flagged a weak first half, which is already reported. But as we come out of COVID and as they start to grow their earnings back to where they should be, it should get some good operating leverage from its infrastructure. So I think it'll benefit from twofold: A, getting the benefits of the ERP system finally once it's in place, and B, just getting back to normal levels of spending in pharmacy, which a lot of it is prevention as well as curing illnesses.
When it comes to some of the other factors to go and consider with Sigma, what do you need to go and look at from a reporting perspective? They've flagged that they're likely to go and return to profitability in FY23. What's some of the nuances to the way that they're going to report their earnings from now on?
No, absolutely. So firstly, they're a January year end, so out of cycle reporter. So one of the reasons that they'll return to profitability is because of the revenue they lost from basically having a problematic ERP system that weren't able to service their clients appropriately in the first half of the year. So as that revenue returns, and with the operating leverage in the business, they should actually have a strong second half and a strong FY24. So it's more about getting back to normal and getting the benefits of scale that comes with getting more revenue through a fixed network.
You started off talking as well about Elders as well in the agricultural space. A lot of diversified revenue streams in that business. Obviously, really big boom times over the past few years, but it is famine and feast at the moment when it comes to like some of the the way that the agricultural sectors are here in Australia. What do you like about it from a medium, longer term perspective when it comes to that earnings outlook?
No, a good question. So I like Elders because it is diversified. They service livestock trading, farm inputs, fence posts, financial services, etc. So it's not a one-hit wonder. And although parts of the market are booming, it's not booming across the board. So there's always part of the country that isn't doing as well as the other parts. You might have one commodity price up, another one just doing okay. But Elders also aims to grow through the cycle. It aims to grow its EBIT at 5 to 10% per annum through the cycle, in part through organic measures, in part through acquisitions. So if we do get a slowdown, that'll give them an opportunity to make some more bolt-on acquisitions and grow its EBIT and return on capital that way. So that's why I'm not concerned about, we might have a bumper crop this year, and that's great for farmers, and farmers will spend into next year. So that's good for for short-term earnings. But if we do get another drought, for example, that probably puts more assets for sale.